This is ShadowQuant, Crypto Edition, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Friday, July 31, 2026, and this is the New York session. Now, let's get into it. We are deep in the red tonight, with the entire crypto market cap contracting 2.35% to sit at $2.24 trillion. Bitcoin has slipped to $62,877, shedding nearly 3% in 24 hours, while Ethereum trails at $1,860.15. But the headline isn't just the price action, it's the silence. Bitcoin futures demand has collapsed to 2024 lows, meaning the institutions that usually defend these floors have walked away. And yet, in the shadows, Dogecoin is holding its ground, dropping just 1.4% while the heavyweights bleed. Before we dissect the damage, let's look at what's on the tap sheet for Friday, July 31st, 2026. We have two key macro releases landing today that will set the tone for next week. First, the University of Michigan consumer sentiment data comes out. Given the VIX has already climbed to 20.66, any softness in consumer confidence could widen the gap between traditional finance and crypto risk appetite. Second, the Employment Cost Index is released later today. This is a critical gauge for labor inflation and, by extension, Federal Reserve policy expectations. If costs remain sticky, the pressure on risk assets doesn't ease, it intensifies.
What to watch for there is the reaction speed. If the CCI data beats expectations, we might see a brief relief rally in the dollar index, which would immediately pin Bitcoin harder against the $62,000 handle.
The broad strokes paint a picture of structural retreat. Total 24-hour volume has dried up to $65.53 billion, a fraction of the activity we saw earlier this year. Bitcoin dominance is sitting at 56.23%. Usually, rising dominance during a drawdown suggests a flight to safety. But here, both dominance and price are falling. That tells us there is no flight to safety, only a general exit. The Fear and Greed Index is pinned at 14/100, firmly in extreme fear, and the 7-day moving average is tracking even lower at 12. This isn't a dip, it's a regime change. Three headlines are driving the flow today, and none of them are friendly to spot buyers. First, Cointelegraph reports that Iranian crypto outflows have spiked 700% following recent U.S.-Israeli airstrikes. This is a geopolitical liquidity shock, not a market signal. Second, CoinDesk notes that the U.S. Senate housing bill now includes a CBDC ban. This creates immediate regulatory ambiguity for Ethereum-based settlements. Third, Cointelegraph highlights that Bitcoin futures demand has fallen to 2024 lows, with analysts asking if institutions are truly exiting the market. Let's talk about the fear. That 700% spike in Iranian outflows validates the 14/100 fear and greed score. People aren't just scared of charts, they're scared of geopolitics. Capital is literally fleeing borders, and that creates a vacuum where retail traders are left screaming into the void.
From a flow perspective, that 700% outflow is a massive hemorrhage. But look at the secondary effect. PayPay, which owns 40% of Binance Japan, is seeking up to $1.10 billion in a Nasdaq IPO. Capital is rotating out of speculative crypto spot exposure and into regulated equity vehicles. We aren't just seeing a bear market. We are seeing a structural migration of institutional capital from digital assets to public equities.
And don't overlook the core scientific miss. They turned lower after Q4 results disappointed. When miners, who are natural long bias holders, get squeezed by energy costs and revenue misses, the hash rate defense weakens. That removes a floor under the price.
Let's start with the king. Bitcoin is trading at $62,877, down 2.9% on the day, having failed to hold the $65,305 intraday high. The market cap contribution alone explains much of the total drawdown. Grid, technically speaking, where is the floor?
There is no floor right now because the bids have vanished. Look at the volume profile. At $62,877, we are seeing thin air above the $62,425 low. The 2.9% drop wasn't accompanied by a volume spike. It was a slow bleed because there was nobody there to catch the offer. Historically, $62,000 was a support zone. But with VIX hovering near 20.66, cross-asset correlation means equities drag crypto down with them. We are testing the lower boundary of the recent consolidation range.
And remember, Grid, you can't rely on that historical support because the futures demand metric has hit 2024 lows. The institutions that used to buy the dip at $62,000 are gone. They've moved to that pay IPO or they're sitting in cash. The $62,877 price tag is essentially an auction result with zero institutional participation, without leverage or hedging volume. The price is just a reflection of spot seller urgency.
The sentiment data reinforces that void. The fear and greed index at 14/100 is the lowest we've seen since the last cycle bottom. But here's the weird part. The retail community hasn't panicked enough to sell everything. We're seeing a bifurcation. The smart money is hiding in the 700% Iranian outflow data, fleeing risk. The dumb money is staying put, hoping for a rebound. That mismatch creates instability. When the leveraged longs finally flush, the lack of futures demand means there's no one left to absorb the supply.
Which brings me to the risk flag. You're calling this a structural exit, CIPHER, but I'm watching the BCH chart. Bitcoin Cash has dropped 4.2% to $209.52. That is the weakest performance among the major caps. If legacy altcoins are getting hammered that hard while Bitcoin is only down 2.9%, it suggests that the liquidity drain is accelerating. We could see a cascading liquidation event if the VIX spikes further above 20.66. The floor at $62,000 is a mirage. The real danger is a flash crash through $60,000 triggered by margin calls on undercapitalized exchanges.
Moving to the smart contract layer, Ethereum is at $1,860.15, down 3.2%. Chainlink is even weaker at $8.15, off 3.7%, while Avalanche sits at $6.39, down 0.9%. The narrative around tokenization seems to be struggling. CIPHER, how is the news affecting these flows?
The CBDC ban in the Senate housing bill is a direct headwind for Ethereum. It creates regulatory overhang that suppresses decentralized finance TVL growth. Issuers are delaying deployments because they don't know if the legal framework for stablecoin settlements on public chains will survive legislative scrutiny. As for Chainlink, TD Securities is bullish on NYSE tokenization as an institutional turning point. But the market is voting with its wallet. Chainlink is down 3.7% to $8.15, completely rejecting that thesis. The flow data shows no accumulation. Instead, we see passive distribution.
Technically, this is a breakdown. Chainlink at $8.15 has broken below the short-term ascending trendline that held since early July. The 3.7% drop on high relative volume confirms that sellers are aggressive. Meanwhile, Ethereum at $1,860.15 is showing bearish divergence on the 4-hour chart. It's making lower lows while the RSI is trying to flatten out. That usually precedes a wick down, not a reversal. The $1,851.06 intraday low is the next test. If that goes, we open up a gap down toward $1,800.
The sentiment here is particularly toxic. Retail investors are frustrated because they bought the tokenization revolution narrative, and now TD Securities is talking up the NYSE, but the price action is indifferent. This cognitive dissonance is causing a slow bleed in sentiment. Unlike the Bitcoin panic, which is sharp and violent, the Ethereum space is suffering from attrition. Traders are slowly rotating out of utility tokens into memes because at least memes have clear catalysts, whereas here, they're fighting legislative headwinds.
And let's not forget Core Scientific. Their poor Q4 results affect the entire ecosystem's cost basis for security and infrastructure. If miners are struggling, the network health metrics degrade. When you combine declining TVL from the CBDC ban with weak miner economics, the fundamental case for holding Ethereum gets weaker every day. The 3.2% drop isn't just noise, it's a repricing of risk.
Now let's pivot to the outliers. While Bitcoin bleeds 2.9%, Dogecoin is only down 1.4% to $0.06. XRP is at $1.06, down 2.4%, and Solana is at $72.81, down 2.5%. In a market crashing like this, Dogecoin is acting strangely resilient. SPECTER, you mentioned earlier that this might be a trap.
It absolutely is. Dogecoin is down 1.4%, yes, but compare that to BCH at minus 4.2% or Chainlink at minus 3.7%. Dogecoin is not strong. It is isolated. It lacks the institutional depth to be correlated with the broader risk-off trade. When liquidity dries up, big players stop touching Bitcoin and Ethereum, so the remaining tiny slivers of volume flow into Dogecoin and XLM, which is down just 0.1% at $0.17. This is the definition of a liquidity trap. It looks like safety, but it's just a lack of sellers. Once the broader market finds a bottom, this artificial stability will vanish as profit-taking begins.
From a charting perspective, Dogecoin at $0.06 is consolidating tightly. The tight range is compressing energy. Usually when a volatile asset like Dogo goes flat while Bitcoin dumps, it's building a base to catch up or in this case crash back into alignment. The 24-hour high was $0.07 and we are holding near the lows. If Bitcoin decides to test $62,000, Dogecoin will likely whip through $0.06 with little resistance. It's not a support level, it's a pause button.
The flow data supports this. We aren't seeing whale accumulation in Dogecoin. We're seeing low-frequency, high retail volume. The absence of large wallet movements means there's no institutional bid to prop up the price. It's a ghost town. Meanwhile, Solana at $72.81 is showing more genuine correlation. It's down 2.5% closer to the mean, which makes it a more honest indicator of ecosystem health than the meme coin. If Solana starts underperforming Bitcoin, that's the true signal that the alt-season dream is dead.
Sentiment-wise, the Dogecoin holders are the most stubborn cohort in crypto. They interpret this decoupling as loyalty. But looking at the fear and greed index at 14/100, that stubbornness is likely to be punished. When the broader market rotates back to risk-on, Dogecoin might lead the charge up. But right now, in this extreme fear environment, it's just a parking lot for trapped capital waiting for a better excuse to leave. Finally, let's look at the defensive plays. BNB is down just 1% to $586.39. Tron is flat, up slightly at $0.32, and Stellar is nearly flat at $0.17, down only 0.1%. These are the quietest assets in a noisy market.
BNB's relative strength is expected. It's tied to the exchange's internal economy and launchpad events, which are somewhat insulated from spot market volatility. However, the $1.10 billion PayPay IPO news affects the Binance ecosystem indirectly. If PayPay lists on Nasdaq, it may face stricter KYC/AML scrutiny, which could temporarily dampen volume on Binance Japan. That's a subtle headwind for BNB's burn rate, though currently negligible.
Technically, BNB at $586.39 is holding the 20-day moving average. It's the only major asset in our primary basket not breaking key short-term trends. However, don't mistake stability for strength. The 1% drop is just less pain. If Bitcoin breaks $62,000, BNB will follow. The chart is flat, but the slope is negative.
And look at TRX and XLM. They are barely moving because they are ignored. XLM at $0.17 is down 0.1%. That's not resilience, that's irrelevance. In a high volatility environment, assets that don't move are often assets that no one is watching. When the liquidity returns, it won't return to these stagnant pools first. It will return to Bitcoin and Ethereum. Until then, these flat lines are just dead water.
So we have a market caught in a vice. Institutions are exiting via the futures door, hitting 2024 lows. Geopolitics are draining liquidity through the Iran outflow valve, and regulatory noise is clogging the Ethereum pipeline. Apex, synthesize this. Where do we stand?
We are standing in a liquidity vacuum. Grid observation that Bitcoin at $62,877 has no support is confirmed by CIPHER data, showing zero institutional bid. The market cap contraction of 2.35% isn't a correction. It's an unwinding of leverage that never got rebuilt. Pulse correctly identifies that the 14/100 fear and greed score is driven by real capital flight, not just sentiment. And SPECTER is right to warn that the strength in Dogecoin and XLM is illusory. It's just a lack of sellers, not a presence of buyers. The synthesis is simple. Without new institutional capital entering the market, any bounce will be met with selling pressure. The path of least resistance remains down until futures demand accelerates.
To wrap up tonight's ShadowQuant Crypto Edition. Key takeaways. First, Bitcoin's fall to $62,877 is driven by a collapse in futures demand, not just spot selling. Second, the CBDC ban and Iranian outflows are creating a perfect storm of regulatory and geopolitical headwinds that are suppressing Ethereum and broader altcoins. Third, the apparent strength in Dogecoin and XLM is a liquidity trap, not a safe haven. Tomorrow, watch the UMich consumer sentiment and employment cost index data. They will dictate whether this slide finds a temporary pause or accelerates. Stay liquid, stay cautious. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Crypto Edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.